About to retire? We got your back. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast on vacation on December 25th. So Merry Christmas, everyone. And Merry Christmas, Vero, you too.
Hey, Merry Christmas, Mike. Like you've said, it's Christmas Day, and of course, we recorded this in advance. But
Are we?
as you listen, though, I'm about to head to your house, Mike, and let you cook me a nice dinner for Christmas. I'm so excited about that.
Yeah, and as early as we recorded this episode, believe it or not, but my menu's already prepared, so I already know exactly what I'm going to cook tonight.
And what is it gonna be? Are you telling me?
Surprise!
Oh, okay, fair enough. So Christmas is by far my favorite holiday and I just can't wait. But today we also have a gift for listeners. This time of year is always a good one to reflect on goals, dreams, or our next achievements. Retirement is definitely a great but hard transition to make in one's life. So this is why we offer you our best tips for a successful one today. So last week we talked about having a vision and a plan. Today we will implement these visions and plans, mostly focusing on preparing for that transition with a viable budget. Why is budget such a crucial part of retirement transition, Mike?
Well, it is not only a crucial part, it is a very hard part to figure
Mm-hmm.
out. And sometimes I feel that some people will rather just run the projections and let the projection tell them how much they can spend because it is super difficult. So the budget will be different from one person to another, depending on what you want to do at retirement, depending on how much you save, depending on how much you want to spend and how early or how late you will retire. So
Mm-hmm.
it is very difficult to say how much money we're going to spend, but it's going to determine everything else moving forward. So there are some rule of thumb that we're going to look at, and we're going to find a little bit more on how you can refine that budget to ensure that you cover every angles and you still have fun while you retire.
So, the first tip you'd like to share, Mike, is the importance of distinguishing the budget between the first years of retirement and the one during the last years of retirement. How does it differ?
Well, the thing is, when you retire, you're of course younger, hopefully healthier, and you should have like more projects and probably should generate a little bit more spending. Maybe you want to travel a little bit more, be active, meet with some friends, do some activities. Maybe you want also to help your children because they
Mhm.
are starting in life. Usually, when you are about to retire, they are about to create their own family or buy their house. So trying to help them will also have an impact on your budget. On the other side, when you become older, well, you must keep a pretty solid base budget for healthcare. So you're not going to be as active, but maybe you want to spend on some other areas.
Mhm.
So it's important to kind of like determine what will be your active phase of retirement and what will be your aging phase of retirement in terms of budget.
So, in other words, a part of the budget goes from fun to healthcare. But how do you put numbers on that?
Well, most of the time, you're going to start with a base budget and then you're going to add extra spending, such as like buying a new car, traveling, and stuff like that. And then on the other side, you will maintain the same base budget as you grow older. So usually in financial planning, you're not trying to have a different budget every 2 3 years or every 5 years, but rather have like, oh, I'm going to be happy spending $3,000 a month, and then I have a few extra expenses at the beginning, and then at the end I should like 20 years later, I should not spend that much when we're going to keep the same $3,000 a month.
But Mike, this is kind of like tip number two, to have a base for our budget and then plan it to evolve and not mend over time. But why is it so?
So your basic budget will cover regular lifestyle. So it should be like similar in a retirement home, where at one point you're not going to spend as much on food, but you'll need to spend more into healthcare services.
Hmm.
A good rule of thumb to know how much should be spending at retirement is use about 70% of your active budget. So, of course, that's a rule of thumb. It's not necessarily a perfect number, but technically, when you stop working, you also have some expenses that you stop having. And technically your house should be paid off, so that should also have an impact on your budget. Then it's important to understand we consider only after tax money. So you need to know how much you spend and not how much you earn to know
Hmm.
what's your budget about. Because when you go to the grocery store, well, you pay that, you pay the bill with after tax money. So that's the most important part. Then you will increase your base budget specifically for traveling, for having new cars every 5, 8, or 10 years, helping children, or maybe it depends. Maybe your goal is to die with $0 at the end. So you want to spend all your money. So then it will be an exercise where you do the projection and you're trying to spend as much money as possible, getting to zero towards the end of your life expectancy. If you do that, I would probably suggest that you plan for 95, 100 years old, because you don't want to spend
Hmm.
everything and you're 88 and still super healthy.
Hmm. In number three, we have projections. What are the keys to good retirement projections, Mike?
So, as we mentioned in the last episode, a good financial plan will include the asset projection and the cash flow projection as well. So, in other words, how your assets are going to evolve over time and where you're going to get that money to finance your budget. So the base budget plus the special expenses, you want to keep it like as clear and as simple as possible. You want to
Hmm.
make sure that you know, okay, so every 5 years, for example, I'm going to spend like $50,000 on a new car. So you enter that into your budget. You do not forget to consider inflation. That's super important, because the same $50,000 today and the next $50,000 in 20 years from now, not going to be the same car. So
Right.
maybe you want to reallocate that just a little bit more. The good retirement projections will show the impact of those special expenses, those major withdrawals on your assets, because of course it's going to trigger maybe a little bit more taxes. So then you have the possibility of either smoother the taxes with higher withdrawals every year, so you can build a cash reserve or a budget that is in non-registered or in your TFSA, and then every 5 years you make that withdrawal. So that's one strategy you can use. And you can also look at how the cash flow is going to go from which account, so you don't have to withdraw $100,000 from your RSP because you have several expenses at the same year. So you have like home renovation, a new car, 2 cruises, and a gift
Hmm.
for your latest wedding, your latest son's wedding. That could be quite expensive year in terms of taxes. Maybe you want to 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 spread that over a few years. So tax optimization is super important. And then the projection will tell you what's going to happen to your estate. So it's great if you want to help your children to allocate a part of money in your budget. So then you know the impact on your retirement, but also on your
Hmm.
estate, between spending all that money while you're living or waiting until the end and trying to compound those investments as long as possible. So those are like different visions. All choices at this point are personal, so there's no like black or white answer. It's really about what you want to reach at retirement and which kind of retirement you want to live. But if you do not have a good retirement projection and you do not have a solid budget, thinking about whatever you may spend on a weekly, monthly basis plus those extra expenses, you may end up with bad surprises. So it's all about to have a little bit of wiggle room to make sure that you have enough for not just the next 5 years, but the next 35 years of your retirement.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. And what's the guideline for inflation? Because I mean, it can fluctuate. So when we think about 20, 30, 40 years, what's the percentage that people should plan?
Um, I like to go with basic average because, yes, if we look at the inflation between 2021 and 2024, it was relatively high. But if you look at inflation between the financial crisis of 2008 and 2020, it was below 2%. So at one point, the Bank of Canada's target is 2%. The Fed is pretty much 2% as well for inflation. Why they target roughly that 2% is because below 2%, you have a weak economy. This means
Mm.
that people are not getting enough pay raises, companies are not selling more stuff, there's not enough demand in the economy to keep it rolling. Over 2%, well, you have the risk of having a overheating economy. So whenever the inflation rate goes above 2%, you'll see central banks like they just did between 22 and in 22 and 23 to raise their interest rate to slow down the economy and get inflation into order. If we have a very weak inflation, well, we don't want to see the economy slowing down and eventually declining, so then they're going to lower the interest rate to boost up the economy.
Mhm.
So all that to say that if you're planning for the next 30 years, 40 years of retirement, a 2% inflation rate should be great. You can always use a stress test at 3% to see what's going to happen, but I would not plan on 3%. I would just use it as a stress test because
Mm.
if you plan at 3%, this would mean that the economy would be on fire all the time, which I don't think is going to happen for 30 years.
Mhm. Okay, but Mike, how often should we run these projections? Because I mean, it could be very tempting to go with all those what ifs, and things always evolve. So I doubt that they stop doing so once we retire. So what are the real good reasons to run them again and make our plan evolve?
So yeah, so that sounds a lot like how often should you look at your portfolio and make
It does.
modifications, right? It's like all the time. Yeah, you don't want to do that. So for the projections, of course, it's great to have a checkpoint, especially once you are retired. It's good to have a checkpoint once a year, just to make sure that you are on the right path. Your assets are supposed to be where does like the value is aligned with the plan, and you prepare your different investment accounts to withdraw money from those depending on the sequence of withdrawals. So once a year, it's a good target, but to redo the entire projections, most of the time you will be on pace unless there is a major event in your life. So a like your spouse that pass away, you sell your house, you decide to buy a boat, like major
Hmm.
expenses like this. So those would be major events that would have an impact on your budget and on your retirement plan. But in general, a simple checkpoint just to make sure that your accounts are at the right value and that they are prepared to generate the income you need for the following year. And you're all good to go. We do have a tool at Retirement Loop, in an online community that we just recently created, where you have what we call the snapshot. So every year you can run the snapshot and you know exactly where the money is going to come from for your retirement. So all sources, so from pension, from government benefits, withdrawing from your investments, and so on. And then you can make sure that you are prepared for that. But doing this once a year, not more than that. Don't go crazy. Same thing with is your portfolio. Just
Hmm.
let the plan works its magics. You did the hard work already once. You don't have to redo it every single time you think about something new.
And if you'd like, by the way, listeners, if you'd like to know more about Retirement Loop and join our wait list for our public lunch, visit thedividendguyblog.com/loop. Okay, Mike, tip 4 is crucial because you have noticed many people making mistakes here. and it is to put the investment strategy over tax optimization. Why should we put them in this order?
Yeah, so the just to make sure that we don't confuse anyone, the mistake is actually to put the tax optimization in
Right.
front. So the tip is putting the investment strategy first, but the mistake is most people think about they suffer from tax obsession.
Mhm.
Literally, they just don't want to pay taxes, but they don't look at the global picture. I mean, if you pay less taxes, but it refrains from you to have like a clear investment strategy that will help you grow your portfolio a lot faster, maybe you're doing something wrong. So I always favor to have a strong investment strategy first, and then you look at each account and each way you can optimize taxes. So then it's a good way where you minimize the tax that you pay, but at the same time you are still confident in your investment strategy and you can
Mhm.
move forward. I've seen a lot of investors thinking, oh, I'm going to pay just $100,000 in taxes right away, right now. I'm going to deplete my RSP to get like right away. So they run the projections and they think, well, if I do that, I pay only $100,000 in taxes instead of like 300 in 25 years. The thing that they don't look at is what would be the investment net of taxes. Because if you don't deplete your RSP right away, you let it compound tax free for several years. So maybe the choice you have is to have a $200,000 portfolio today and pay $100,000 in taxes, but maybe have like $1.5 million in portfolio and just pay $300,000 in taxes at this point. Well, I will take the $300,000
Mhm.
in taxes to be paid in 25 years at this point. Of course,
Mhm.
I'm exaggerating. The numbers probably don't work if you run them with a calculator, but when you do the projections, you'll see that sometimes it's best to let compound that money in a tax-free account. And then in some other times, it's the opposite, where it's better to deplete your RSP faster. So you pay your taxes up front, and later down the road, maybe you don't have OAS clawback, maybe you don't have to pay extra taxes for your estate, and then it becomes a better option. The solution is always to run projections, run different scenarios, and have a global picture for that. But in the end, if you change your investment decision just based on taxes, you're probably going to lower your expected returns, which is going to have like a negative impact on your overall retirement.
Mike, we are about to share such exciting news with listeners. I can't wait to see their reaction. Over the years, we have seen how Canadians need guidance and support to transition to retirement, and we've decided to create Retirement Loop for them. What is Retirement Loop?
So, Retirement Loop has been created to answer a big problem in the industry. So, a lot of people, they want to manage their portfolio by themselves, they want to take control, but they do still have a lot of questions about when is the right time to convert their RSP into a RIF, when is the right time to take CPP and OAS, and all the other questions like such as when can I retire, how much can I spend, and what is the best way to minimize taxes. Their only solution is usually to go see a financial advisor. Unfortunately, the way that financial advisor are like paid, they're more interested in selling investment products than actually doing that kind of work. And I'm not saying that none of them are doing it, but a lot of people thought maybe I couldn't do it myself and I can learn how to build my own plan.
Mhm.
And once I'm retired, making sure that everything is under control, I make the right checkpoints, and that the ship is steady. And this is exactly what Retirement Loop is. It's a retirement community where everyone can help each other. So, plenty of people that are about to retire or that are retired already, enabling to share their experience and learn together.
But, Mike, what tools, resources, or connections should members expect in this community?
So we decided to divide Retirement Loop in three categories. We have the planning space where you're going to build your own projections. So you're going to find tools on how to build your projections, build them, and then optimize your taxes. Then there's the part about investing, because yes, it needs some money to retire, apparently. So we're not going to talk about like how to find stocks as we do at Dividend Stocks Rock, but rather talk about various strategies such as like ETF, bonds, stocks, covered calls, you name it. So the goal is how you can create your paycheck at retirement using a good strategy. And then there is the enjoy part, because retirement is not about finance, it's about enjoying life, right? So you work super hard, and at retirement, it's time that you enjoy the life. So we're going to talk about traveling, staying healthy, talking about other hobbies. So the goal is really to enabling that connection across many people in your situation, looking for answers and having a good time to just enjoy their retirement a little bit more.
And as soon as we publicly launch the community, there will be a limited time discounted price offer, right?
Yeah, and that was kind of crazy. We did a pre-launch among DSR members, and we have over 500 members already.
Mm-hmm.
So yes, there will be a special price. It's coming up, and that price is going to last for just a few days, and then we're going to close the doors, because the goal was not actually to reach 500 members on the first year. So I'm almost putting the brake right now to not let too many people in, so we can all have a nice experience and that we can grow as a community. But definitely, I think we just hit the nail right now, having the a great service, helping the right people.
Mm-hmm. So think about that, listeners. Over 500 members ready to welcome you. You don't want to miss this. So join the waitlist now to get more details and access the discounted lunch price at thedividendguyblog.com/loop. Thedividendguyblog.com/loop. I'll see you there. But Mike, I want to make this real clear for listeners. So, like in simple words, like just a quick summary, what are the real dangers of tax optimization obsession?
Well, in my mind, there are two. The first one is it makes it very complex for your plan to follow. And at retirement, what you need is not complexity, but rather having confidence and just being stress free. So having something simple, it's easier to do. And then the second thing is sometimes to focus on short term tax gain and ignore the long term gain. So having a global view instead of focusing on how much you're going to pay in taxes today.
Okay, so the last tip for today is to have a cash reserve. Why is a cash reserve essential?
Well, I just talk about confidence, right? Well, confidence always starts with peace of mind. So having cash on the side in a savings account or a GIC will help you sleep well at night. So your portfolio can go everywhere it wants. You know that for the next 12 months, for the next 2 years, you have enough money in cash and you don't have to worry about whatever is going to happen and which kind of crisis we're going to have, or if we're going to have election or not in this year. So for the peace of mind, that is like a number one trick. The second thing is, of course, it's helps to smoother withdrawals, especially if you cannot live off your interest or dividend income, but you need a combination of selling shares and generating income from your portfolio. You don't want to get stuck selling shares when the market is down, like in 2022. So if your portfolio is down like 15% and then you have to sell for 5% worth of your portfolio, it's kind of like a double dip. And as it will not be permitted on Christmas tonight when your children is going to come around, well, the same thing. Double dip is not a good thing for retirement withdrawals. So when you have a bad year, you can take money from your cash reserve instead. It's a lot better. And then how big the cash reserve should be, that really depends on how secure you want. I even had a client back then that had 3 years of full retirement budget in cash reserve. In my opinion, it's a bit overkill. Of course, you leave a little bit of money on the table because that money is going to just generate a small interest every year. On the other side, if it helps you sleep well at night and you don't need to generate more returns, there's not really a problem here. There's always that balance where you can optimize like the math, but you can also optimize to just feel good about your retirement. And if feeling good means having 3 years worth of retirement budget in a high savings account, well, there you go. You do it. You're happy. You're stress free. You can enjoy life. That's worth probably a lot more than the expected return that that cash should have generated.
Now, there are many ways to build a cash reserve. Could you describe the two, three ones that seem the most efficient to you, Mike?
Sure. First, you need to plan in advance. It's always easier. So you could just build it with your portfolio income by stop dripping 2, 3 years before you retire. So just accumulating the dividends, the interest, or additional savings just right before retirement so you can build the cash reserve that you want. The other way that you can do it is, of course, by getting rid of like some bad stocks that are laying in your portfolio. So when you do your cleanup, you can sell companies that are not aligned with your investment strategy anymore, that have like poor performances with poor financial metrics. That could just not be aligned with your investment thesis anymore. So you thought this company would be great, but they're not doing what you expected to do. So you get rid of those. It could also be made through do some reallocation. So you rebalance your portfolio. If you're overweight on a specific stock or a specific sector, you just want to rebalance everything. You can sell a little bit of each, and then build that cash reserve. The key again is to plan it in advance, so you're not rushed to do that. So you have plenty of time to accumulate enough money on the side to either cover for the gap between how much your portfolio generates per year in income and the budget that you need to withdraw, or you go for full years of budgets, fully backed by cash, so you sleep well and you don't mind leaving a little bit of returns on the table.
All right, so let's summarize the 5 tips to a successful transition to retirement. Tip number 1, separate your budget into 2 phases, first years and last years of retirement. Tip 2, make your budget evolve, change, and augment over time. Tip 3, run projections to make sure the numbers add up, but not too quickly or not too often, I mean. Tip number 4, prioritize investment strategy over tax optimization. Tip 5, build a cash reserve for peace of mind during tough years. Is there anything you'd like to add, Mike?
As much as it's fun to run multiple projections and scenarios and try different things, keeping everything simple and clean is probably the best advice here. Same
Mm,
thing with your portfolio. If you do have a super high complex investment strategy, chances are you're going to suffer from paralysis by analysis. Well, when it comes down to retirement, if you have like 50 pages of calculation with 32 scenarios, chances are you're gonna like wonder which scenarios is the good one and which on which pages you can find the information. So try to keep everything simple. And then your retirement is just going to be so much easier
right.
and enjoyable.
Mhm. Well, thanks again, Mike, for helping us build a sound transition to retirement. Listeners, I hope you have a wonderful Christmas that will fill your hearts with great memories and urge you to have the best retirement possible. If you'd like to join a community of like minded people to help you transition to retirement or keep the ship steady while you're there, join our retirement loop waitlist now at thedividendguyblog.com/loop. For the show notes and related content, visit thedividendguyblog.com/207. Never miss an episode again and show us some love for Christmas by subscribing to the show now and leaving us a 5-star rating. See you again in 2025 for our special How to Invest series with 5 episodes in 5 days. Until then, Stay invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.